Everyone hears SBA 10% down and thinks it's a cheat code. It's not. SBA can be unfair advantage, but only if the deal is bankable, the structure is clean, and your buyer story makes sense. Today, I'm going to tell you what 10% down actually requires. And I'm going to tell you exactly why lenders say no. If you're new here, my name is Bourgana. I help high performers buy profitable small businesses using SBA financing and an operator playbook. So you start with cash flow, not hope. And quick thing, if you want my SBA buyer pack, comment SBA, and I will send you the readiness checklist, the lender document list, and my underwriting template. All right, let's get into it. Here is the truth that nobody says. The lender is not funding your dream. They're underwriting risk. In plain English, they're asking only one question. Can this business reliably pay us back even if things get messy? That's it. And that means SBA, it's not about you. It's about the business's ability to service the debt. Yes, you matter, but you're secondary to the cash flow. So what do lenders actually look at? They look at 1, cash flow coverage, 2, consistency of earnings, 3, how real the add backs are, 4, customer concentration risk, 5, how dependent the business is on the owner, and 6, clean financials and clean tax returns. Let me give you the simplest summary. If the business is a mess or the story is a mess, the lender will pass. SBA underwriters are not focused on you first. They're focused on whether the business can pay them back. Now about that 10% down. 10% down is a headline. It's not full cash requirement. Because even if your down payment is 10%, you still have closing costs, legal, appraisal, lender fees, and almost always some working capital requirements. And beyond that, most lenders want you to have liquidity after close. They want a cushion. So here's the rule. If you have exactly 10% and nothing else, you are going to have a hard time. Not because SBA is unfair, because you're undercapitalized. Let me say that differently. Down payment is not the same thing as cash needed to win. Down payment is just one line item. But here's the beauty of the SBA loans, is that the same lender can provide additional equity or additional cash for your working capital, as well as a line of credit for you to use as working capital. So you get both the cash up front and you can get a line of credit, which I recommend that you make sure that your SBA lender will provide that line of credit up front. Not all lenders do. So make sure you work with a lender that can provide you that line of credit up front, because once you close your SBA loan, a lot of other banks won't touch you. Now let's go through the most common rejection reasons. Number 1, the cash flow doesn't support the debt and the payment is too heavy, or earnings are too volatile. Number 2, the add backs are just a fantasy. They're not documented, they don't repeat, or the owner is just claiming some nonsense. Number 3, owner dependency. The seller is the business. They are the salesperson. They hold the customer relationships. They run the operations. So if the seller leaves, the business collapses. Number 4, eligibility issues. Sometimes it's industry. Sometimes it's business model. Sometimes it's a passive income profile that doesn't qualify the way people think. Number 5, your buyer story does not match the deal. That doesn't mean you need to have experience in that exact industry. It just means you need to be credible. If the lender cannot see how you will operate this business, they will not take the risk. Now, let's talk about you. Here's what matters for the first-time SBA buyer. 1, credit. Not a perfect 800, but just a clean story, no chaos. 2, liquidity. Not just 10% down, but a little bit of cushion just in case. 3, time commitment. If you're buying a business and you're too busy to run it, you're not buying a business, you're buying a problem. 4, your experience narrative. And I want to be very clear here. You do not need to be a 20-year veteran of that exact industry, but you need to show you can lead people, manage numbers, run processes, and execute a plan. That's what lenders want. Here's a simple framing I want you to use. I have transferable operating experience. I've managed teams. I've managed budgets. I've built systems. I can execute a plan and drive performance. That's the story that matters. Now, if I want SBA approval in the next 30 to 60 days, here's what I would do. I would build a lender-ready package. I want 3-year tax returns, 3-year P&Ls, interim financials for the year, balance sheet, account receivable aging, account payable aging, a real add-back schedule, and a plain English business plan. I would just include a 1-page borrower summary showing my liquidity, showing how much is my credit score, a little bit of my experience summary, and a little bit of a deal summary. Then I would talk to 5 lenders, not 1, 5, because lenders have different appetites and different speed. And I would pick 2 out of the 5 that communicate clearly, understand my deal type, and have a real process. So here's the bottom line. SBA is the biggest unfair advantage in the US. But it's not magic. The deal must be bankable, the structure must be clean, and your story must be credible. If you want the SBA buyer pack, comment SBA and I will send it to you. And if you're buying a business in the next 12 months and want a real structured process, apply for the Acquisition Collective.